Welcome to another episode. My name's Jose Najarro, and today we're going to take a look at Uber's Q4 earnings. So let's get started. Before we begin, don't forget to hit that subscribe button. So before we take a look at their earnings, I just want to talk about some of the articles that are recent about Uber. The first one is Uber tests their telephone bookings. So Uber actually just opened a phone line where you can call now. Instead of using the application, you can actually call. You can call the number and schedule an Uber ride. So like that, you don't have to have the application to be able to use it. I think they're testing it out in only a few states yet. The pilot program is in Arizona at the moment. So they're going to see how that's going to do. And if it does well, they're going to bring it out around the states. The second thing is today, February 18th, Uber shuts down the LA office and is laying off about 80 workers. So those are the two main articles that are out right now. All right, so now let's start with their earnings. They announced earnings on February 6, 2020. The earnings per share were negative 49 cents, which was a beat by 3 cents. So this company is actually losing money each quarter. Revenue was 4.07 billion, which beat by about 11 million. 11 million beat is not a huge surprise when it comes to a 4.07 billion dollar revenue. Next, let's take a look at annual earnings per share estimates for December of 2020. This company is expected to have earnings per share of negative $1.13. So this company, even for this year, is still going to continue to lose money. For December 2021, this company is expected to make a loss of 30 cents, which is a lot less than what's expected for this year, but still a loss. This company is still going to continue to be on the negative for 2020 and 2021. Next, let's take a look at the revenue for 2020. This company is expected to make $17.92 billion, and for 2021 is expected to make $22 billion. So from 2020 to 2021, this company is expected to grow revenue growth of about over 20%, which is pretty strong, right? For already a company that's producing revenue in the teen billions, it's pretty impressive for this company to continue to go up by about 20% growth. Here we can see the forward price to sales ratio is less than 4. For 2020 is 3.8, and for 2021, this company has a forward price to sales ratio of 3.09, and that's actually pretty low for a technology company. And I do consider Uber a tech company because it's not just a ride sharing. They also do a lot of other stuff that we're going to talk about in this episode. So once Uber does become profitable, one of the scary things right now is that this company is burning money, right? For 2020, this company is expected to burn $1 per share. And even in 2021 is still expected. But once this company is able to be profitable, hopefully in 2022, we can see this company profitable. That forward price to sales ratio is actually pretty low, and I can see why there's a lot of people willing to buy this company at this price. All right, so the first thing from their earnings, we're going to take a look at the presentation they gave to their investors. And remember, their earnings for Q4 was on February 6th of 2020, and I took the liberty of highlighting all the important information that I thought was useful about this presentation. So the first thing, remember, like I mentioned about a minute ago, that I consider Uber a tech company or more than just a ride-sharing company, because they do have different types of segments. Their main segment, as we all know, is the sharing of rides, but they also have Uber Eats. They have Uber Freight, which is for the trucking business. They're able to have jobs for the truckers, which I think it's pretty cool. It's like a Uber rides, but for truckers. They have New Mobility, which if you've gone to some of the cities, they have bikes, scooters, and other type of small transportation devices opposed to cars. In some countries, I think is Dubai, they have the Elevate transportation, which is like some form of helicopter or small plane. And then they also have this ATG, which is pretty much their smart type of technology with self-driving. So they are in 69 countries and they are in over 900 cities. All right, so now we're going to take a look at their yearly numbers. So first, gross booking for this company for this year of 2019 was $65 billion. For 18 was 50 billion. For 17 was 34 billion, and for 16 was 19 billion. So we can see a strong growth in gross booking for this company. Just in this year alone, this company has a 35% year-to-year growth. So like I said, a gross booking in double digits year-to-year growth is pretty impressive for such a big company, right? From 50 billion to 65 billion is a huge jump, and we're still going to continue to see this in the upcoming years. This company right now has about 111 million monthly active consumers, which is up 22% year-to-year growth, and it's up 20 million more users than it was same time last year. At the end of this year, this company did 7 billion trips, which is up 32% year-to-year growth, and it's up 1.7 billion compared to 2018. So we can see double-digit growth in gross bookings, double-digit growth in users, and double-digit growth in trips that this company provided. All right, so next we're going to take a look at the revenue and how it's distributed between its segments. The first one is rides, and that makes up 76% of the total gross bookings for 2019. So we can see rides is a huge portion of this company's revenue. So now we're going to see that here Uber provides a map, and they mentioned that they're the #1 in every major region which they operate: United States, Canada, Latin America, Europe, Middle East, Africa, and India. And then in places that they don't really operate, they have ownership in some of the ride sharings in that place. So for example, in Russia, they have 30% ownership of Yandex Taxi, which is the number one in Russia. In Southeast Asia, they have 19% of Grab, and in China, they have 15% ownership of Didi. So if they're not in there, they're also in there in some form of ownership with the leader of ride sharing in that country. So now we're going to take a look at gross booking for Q4 of 19 compared to Q4 of 18. It is up 20%, and adjusted net revenue is up 32% compared to same time last year. Right now we have a 5.7 average monthly trips per rider, which is also up. I think we'll see a chart later that previously was like 5.6. One thing I don't like about Uber and a lot of tech companies that are doing right now is they're doing a lot of adjustment when it comes to net revenue, when it comes to earnings. And I don't like seeing that, because all these expenses need to be tracked. And I rather like seeing the final result opposed to this adjusted, which makes things look a lot nicer. So it's something we're going to take a look at when we look at their balance sheet or their income statement, that this company does do a lot of adjusted revenue, adjusted net incomes, which make the numbers look better than they really are. And they have their own reasons for doing this. They say that these numbers that they're showing after adjusting is the true growth of the company. But like I said, at the end of the day, this company uses those expenses no matter what. So we should actually see the final results opposed to these adjusted numbers. So continuing the ride segment, we're going to take a look at the take rate. And the take rate is pretty much what Uber takes from its Uber drivers. In Q4 of 18, this company used to take 20.4% of the Uber rides revenue. In Q4 of 2019, that increased to 22.5%. And for the long term, they want to reach a 25% take rate, and they're going to leave it at that. And I think Uber has a lower take rate than Lyft, and that's why some more drivers are more likely to go to Uber than to Lyft, because they take less revenue from them compared to the other riding segments. Next, we're going to take a look at Eats, and this makes up 22% of the total gross bookings for 2019. So it's pretty. They do mention. I do think Eats is a very. It's going to be one of the biggest. It's going to continue to grow, and it's going to be a more of a money giver for Uber eventually. Because look, we can see the average Eat order is 50% larger than bookings from average ride trip. So if we had a 1-to-1 ratio, then this company would make more money from Uber Eats than it did from Uber Rides. There also is a lower insurance cost due to in Uber Eats, right? Because in the Uber rides, the company has an insurance for both the passenger and some form of insurance for the driver. When it's just Uber Eats, it's just one person delivering food, so that insurance cost is a lot less for it. So it's a lot less cost Uber Eats, so they have greater margins. So here Uber, that's pretty cool. They show some of their competitors in the Uber Eats platform. They show Takeaway.com, Delivery Hero, Grubhub, and Just Eat. And we can see in 2017, Uber Eats was actually one of the lowest. In 2016, Uber Eats was the lowest one of all. In 2018 was the first time this company passed all of them. And now in 2019, this company is way above. The next here is Delivery Hero, followed by Just Eat. Annual run rate for this year on Uber Eats was about 14 billion. The next was Delivery Hero, sitting at about 7 billion. So less than about half of what Uber Eats made. So you can see this growth coming in for Uber Eats. Uber Eats take rate has increased as well. Here in the company, in Q4 of 2018, this company's take rate for Uber Eats was 6.4%. For Q4 of 2019, it's 9.5%. So it's up about 310 basis points. For the long term, this company wants to increase that. It wants to take it up to about 15% take rate. So it still needs to grow about 500 basis points, 550 basis points for it to reach that. But that's, again, pretty impressive that this company is making a nice amount of money from Uber Eats, even though their take rate is pretty low. Finally, the next is Freight, New Mobility, and ATG. All three of these make up only 1% of 2019 gross bookings. So remember, 22 came from Uber Eats, and 77 came from Uber Rides. So just like I mentioned, right, Freight is pretty much just Uber for trucks. It allows a truck driver, if you are a truck driver, to actually go into Uber Freights and see if there's a company that needs a delivery. So you go, you hit accept, they give you the price of how much your job is going to go, and you go on for your job. Then so that made $876 million, and it's the biggest out of this 1%. The next is New Mobility. So here we have the scooters, the bikes, and this makes up only $140 million. But it's definitely a big opportunity, because they do mention that trips under 3 miles are 46% of the United States national vehicle trips. So about half of the United States national vehicle trips are less than 3 miles. So here Uber Eats thinks that with all these other types of ride platforms, so bikes or scooters, they will be able to pick up a huge market share. So next they have their ATG platform, which this is much of their high thinking, their high technology segment. For example, they have partnerships with Toyota and Volvo. With the Toyota, especially the Toyota team in Pittsburgh, to develop and deploy automated ride-sharing services through deep calibration. So here we can see some of the different platforms they're working. They're working with Toyota, Denso, and Volvo to do that. So right now, this is probably doing the less amount of revenue for Uber, but it's understandable because this is more of development for the future. Next, we're going to see their path to achieving profitability in 2021. This company says in 2021, this company will make money, but this is based on their adjusted earnings before interest, taxes, depreciation, and amortization, which again, I don't consider this true profitability, because at the end of the day, this company is still going to be burning some money, but this is helping. It's definitely a push in the right direction. If this ends up positive, eventually in the coming years, the true net income will also end up positive. Next, we can see this company has a nice liquidity position. It has about $10.9 billion in unrestricted cash. So this company can continue to burn some money and be able to afford it. And it has equity stake in a lot of outside companies. We saw Grab 2.3 billion. Diddy has it's invested $8 billion. And like I mentioned, these are some of the companies I mentioned above where Uber might not be working on, but they have a stake in some of the companies that are the major contenders in that space. All right, so now we're going to take a look at some financial numbers. The first I want to take a look at is sales, some of the expenses they have. The two I always take a look at are sales and marketing and research and development. So sales and marketing in 2018, this company had $933 million. In 2019, this company for this last quarter, this company had $1.2 billion. So we see an increase in sales and marketing, which I always think is a good thing, right? Because it means this company is focusing on having more revenue by having a stronger marketing and sales team. Same with research and development. Research and development for quarter 4 of 2018, this company had $361 million. For this quarter of 2019, it had $468. And we can see every quarter since has been increasing little by little. So, and I think research and development is a very good thing, especially when I consider this company a little bit more than just a ride-sharing company. I do expect this company to continue to develop itself in applications and other forms of improvements. Next, we're going to take a look at how they do their GAAP to non-GAAP thing. And this is something I don't like I mentioned before. Right after the numbers they're reporting are they had a 615 million loss, but in reality they had a 971 million loss when we take account everything to the number. Then we're going to take a look for 2018. For 2018, this company had about a $1.05 billion loss. So yes, they were losing both last quarter of 2018 and the last quarter of 2019, but it does seem that they are improving a bit. So right there, last year it was a 1.05 billion loss. This year was a 971 million loss. So about $80 million less this year compared to last year. The last thing I want to take a look at in this presentation is their revenue distribution. So here they have how much rides each freight and others made up in the past quarters, and we can see in 2018 this company had $2.3 billion in rides, and actually every quarter it was increasing a little bit, and now in 2019 is sitting at $3.03 billion. Eats is the one that's growing the fastest. Look at Eats started at 165, then to 239, then 337, then 392, and now 415 is the one constantly increasing every quarter. Where rides, we can see rides was pretty still in March. It was also pretty still in June 30. It jumped dramatically in September, and it jumped again in December. Next, we have Fright. Fright is another one that in March was pretty stable compared to December. So in December of 18 was 125. In March of 19 was 127. Then it jumped big in June of 30th to 167. Then it jumped again in September of 2019 to 218. And compare that to now in December of 2019, it's pretty much flat. It grew only 1 million. So we can see, like I said, the biggest jumper here is Uber Eats, and this is one that I'm gonna definitely keep an eye on. All right, so the next one we're gonna take a look at is the numbers the company gave to us. So here we're gonna first take a look at the income statement. We can see revenue growth has increased dramatically. For 2019, this company had revenue of $14.1 billion. And remember, for 2019, this company is expecting 17.92. So again, that's over a 20% growth that we're going to expect to see from 2019 to 2020, and then an over 20% growth from 2020 to 2021. And it was a big growth. It was over a 20% jump compared to 2018. So this company is continuing to deliver a strong double-digit growth of revenue year after year after year. So here, remember how I was talking about sales and marketing, research and development. I just want to take a look at the full numbers for the full year. For 2019, we can see sales and marketing for 2019, For the full year of 2019, this company had $4.6 billion in sales and marketing compared to $3.1 billion in 2018. So we see that growth there, which is good, and that's why we see that huge growth in revenue, because this company is spending more money to create that revenue. Next, in research and development, this was a big jump. In 2018, this company had $1.5 billion of research and development, but now sitting at 4.8. That grew by over 300% in research and development, and that's something I'm not going to complain about, right? Research and development is always an important thing to take a look at. So props to them on that. But here now, let's take a look at net income for this company. For 2019, this company had a total loss of $8.5 billion, and that mainly came from this $8.4 billion loss of income tax and loss. Once we add up all the total cost and expense, this company had a total cost and expense of $22 billion, which gave this company a $8.4 billion loss for the year of 2019, which is a lot less compared to what this company did in 2018. In 2018, this company actually had positive net income for the full year of 2018. And here we can see some of the biggest jumps we see is one, cost of revenue with amortization increased by about $2 billion. We see operations and support increased by $700 million. Sales and marketing increased by 1.5. Research and development increased by 3.3. General administrative increased by 1.2. So this company continued to increase its cost, and that's why this company took a huge loss this year, which I think is pretty crazy how big of a loss for 2019 this company actually took. For example, here in 2019, this company lost $6.81 per share. For 2018, they don't really have a value, and it's okay because this company wasn't at IPO at that moment, so they're not going to show that number. Another thing, if you guys take a look at their 10Q report, you're going to see, right, that the huge increase in equity shares. But again, this company just went IPO, so they released a nice amount of shares. So that's why you would see this. But here in December 2019, we're sitting at about 1.7 billion shares, I would think, or one. So I wanted to take a look at why this company had such huge expense this year. Remember, we saw that $8 billion loss. And this is the biggest, the most important thing I see here is stock-based compensation, which is them paying some of their top dogs. They use $4.5 billion of stock-based compensation, and that's pretty crazy, right? That's ridiculous, and that's why we see that huge loss coming in there. There's also other stuff here and there that start to add up. But the biggest one was that 4.5 coming from the stock-based compensation. And this is something that they take off from their earnings before that EBITDA nonsense. But at the end of the day, this company's still paying this. So it's pretty. This numbers like this still need to show they're paying one way or another. All right. So the final thing I want to take a look at is this company's total assets. So cash and cash equivalents compared to 2018 grew about $4 billion. Now in 2019, they have about $10.8 billion of cash and cash equivalents, where same time last year had $6.4 billion. So that's a good thing to see that cash and cash equivalents. Short-term investments grew about $440 million. Last year, they didn't have any. Accounts receivables increased this year, and again, with higher revenues, you definitely expect accounts receivables to also increase. Total current assets increased by about $5.3 billion, and again, a huge portion came from the cash and cash equivalents and that short-term investments. Next, we're just going to take a look at regular investments that this company has. It has pretty much the same compared to last year. Right now, sitting at $10.5 billion. Last year was $10.3 billion in investments. Total assets at the end of the day increased by about $8 billion. Right now, sitting at $31.8 billion compared to $24 billion same time last year. The only thing I would say to watch out is this operating lease right of assets, which is an asset that they did not have last year. So that's $1.6 billion. And then there's this collateral held by insurers of 1.2. So that's about 2.7 billion, $2.8 billion. So in reality, this company's total asset, if we want to compare apples to apples, will be somewhere around $29 billion, but it's still a growth compared to the same time last year. Next, we're going to take a look at this company's liability. Let's just go straight to total liabilities. Total liabilities are actually lower this year compared to the same time last year by about 500 million. But now they have this lease that again did not have to be marked last year, which was a $1.5 billion lease. So in reality, if we compare apples to apples, total liabilities is actually much less compared to the same time last year. It would be about $2 billion less compared to the same time last year, which is great news for the company. I like to see assets increase and total liabilities decrease. Next, we're going to take a look at long-term debt. This company's long-term debt seems to be getting paid off. Last year, this company was sitting at $6.9 billion of long-term debt. Right now, sitting at $5.7 billion. So again, another good thing to see that long-term debt continue to go down. So that's all I have for Uber. Let's just do a quick relapse of things I liked and things I didn't like. The first thing I didn't like was this company uses that earnings, that EBITDA, whatever nonsense, to show that they're really growing and they'll be profitable in 2021. But in reality, they'll still continue to burn money. Another thing I did not like about this company is the amount of stock compensation that this company gives. Again, I think it's dramatically high, and that's why we see in 2019 such a huge loss compared to 2018. Things I do like is that strong revenue growth, right? We saw over 20% in 2018 to 2019. We see an expected 20% for over 20% from 2019 to 2020, and again over 20% from 2020 to 2021. So this company definitely has strong revenue growth in the future. We see that this company is in different types of segments that can lead up to a huge revenue. Uber Eats is doing pretty well. Uber Rides is doing pretty well. At the end, the total current assets and total current liabilities for this company is doing good. We'd like to see that asset increase with that liability decrease. What else did we see? In the revenue, in the income statement, we saw that this company is spending a lot more money in research and development and in sales and marketing, which again I think are good things to make sure the company grows, especially right now when we have such a low rate market. I think it's a great time for companies to use their full power in growing and borrowing. We see that long-term debt continue to go down, which are good news. So I can see why people are definitely interested in Uber. So I hope you guys enjoyed the episode. Let me know what you guys think. Have a good night and see you next time.